All right. Good morning, everybody. Welcome back to another episode of the Tim and Tim Show live and making moves in multifamily. This week, we have an exciting conversation to be had about refinance debt options. Um, there are a lot.
Go ahead.
Oh, refinance debt options. That's always something that's an interesting topic to discuss. And I think that it can be rather confusing for a lot of different people to have an understanding of what your options are. So we wanted to talk about it because Tim and I are looking at a lot of refinances at this point in time. At this point in time when we're recording this, the Fed is looking at reducing their rates in the next 2-3 weeks. Uh, which is seems imminent at this point. So the refinance activity is going to pick up in a major way. People getting out of high interest rate debt that they maybe acquired over the last year or two, or people looking to acquire new deals with new fresh debt and things like that. So very exciting show today. But first things first, Tim Vest, how you doing today, man?
Not too bad. Ready to get the week started.
Oh yeah. Hope you had a nice Labor Day weekend. We got a lot of rain here, and weather finally seems to have broken. It's not like 100 degrees out today, which is nice. I got the windows open, so nice change of pace. Um,
Yeah, it's maybe summer's finally done. I'm a little sick of it.
yeah. All right. So first things first, what I want to do is identify the different types of refinance options that you have. I took some notes over here because I wanted to make sure that I cover everything correctly, and then we can kind of talk about things that are, why you would use different pieces of debt, why you wouldn't use pieces of debt, when they become favorable, when they may not become favorable. And let me preface this whole conversation with what our preferences are and what the options of debt that we have available to us, depending on our markets and the asset types. Everything is going to vary for every individual. So that's why it's so important to make sure that you understand all the different debt options that are available to you. So first things first, Freddie Mac or Fannie Mae multifamily loans. Those are very commonly discussed as agency loans. A common term that we use in the multifamily world is an agency takeout. So typically, a lot of people, like ourselves included, we will go in, we'll buy a property with a short-term bridge loan, which is in the single-family space, like a hard money lender. We'll buy it with a bridge loan, 24-month option, and then we are looking to get a takeout loan in one of these buckets, actually, that we're discussing today. So either going to do a Freddie Mac or Fannie Mae takeout agency loan. You have CMBS loans, which are commercial mortgage-backed security loans. You have conventional bank loans, which are your local and regional banks. You have life insurance companies. You have HUD and FHA loans. And I think that's it. Tim, did I miss anybody that you can think of?
No, not really. I mean, there's all kinds of lending options out there, but those are kind of the big ones that
Yeah,
most
those
that
those are the
most that most people have access to.
Yeah, those are the major ones. The most common being the agency takeout loans. With most people in the industry that we know, you could buy property with an agency loan right out of the gate. Typically, your business plan looks a little different, but at least for us in the value add multifamily space, we are typically buying with a bridge, and then we're looking at some kind of takeout loan. So,
Yeah, yeah. Most of the stuff we buy, most of the people that we know are value add operators, and typically, if you're doing a value add of some sort, you're probably not going in with an agency loan. Um, you're probably doing some sort of shorter term or some sort of more flexible financing at least.
yeah.
Um,
Yeah, because typically on, value add deal, you're not gonna be able to get the loan that you need or the leverage that you need because your debt coverage ratio is gonna be so low. Um, you know, Fannie, Freddie, depending on the market, depending on the loan type, I've seen as low as 1.2 DSCR. So that says, if your mortgage is $100,000 a year, the property needs to make $120,000 a year so that you have 20% on top of your debt service in order to qualify. Um, when you're typically buying a value add deal, the income is lower. And if they give you a loan based on in place cash flow, your loan proceeds are really going to be crushed because you have to, you know, be constrained by your debt coverage ratio, especially with those agency loans.
Well, and then they tend to be more costly to refi before they're to refi or get rid of before their term is up. So, again, like if you're thinking about a value add piece, you're either thinking value add, I'm going to go in, add add significant amount of value to the property and then sell it, tap that equity, or I'm probably going to refi it and pull like a burr strategy on it, refi it, pull equity out and go do something else. Well, if I'm going to refi that in 12, 24 months, agency loans probably aren't the best play.
Right. Totally agree. Yeah. So
Yeah.
agency loans, the small balance loans are typically anywhere from a minimum of $1 million up to about $7.5 million. The terms on an agency loan are typically in a 5 to 10 year period. Um, Correct me if I'm wrong. Have we seen 3 year options from them or no?
No, we're usually quoted 5, 7, and 10s, I
Five, seven,
believe.
10. Yeah. Yeah. 5, 7, 10 are definitely the most common. Well, I guess the CMBS loans are typically when you can get a 3 year option or
Yeah,
most
and
bank.
and and honestly, guys, like if you want to talk about CMBS loans, I can point you to somebody to talk about those with. I've never heard. I'm not talking junk about anything, but I've never talked to anybody that has one that's happy with it. So I've just never done one. I've
Yeah.
never looked at them. So
Yeah. So with agency loans, you can typically get 5, 7, 10 year loans. Those are the most common ones that we see. I've never not seen a 30-year amortization on the debt when it comes to an
right,
agency loan, which is a very nice thing because it really helps out your debt coverage ratios because it just stretches out your debt over a longer period of time. Therefore, your debt service is lower, which enables you to get more leverage and be within your constraints of your debt coverage ratio. Um, Go ahead. You're going to say something.
no, yeah, yeah, yeah. That's about right. I mean, at some point we'll get to kind of like the downside of agency.
Yeah, right. Yeah. So we
Yeah,
we could go there. So I want to talk about the advantages and then we can talk about disadvantages. So interest
sure.
rates, you can typically get fixed rate or variable rate. When you're getting a refinance, your loan broker will typically give you some options of what that looks like. Prepayment penalties, they can be either yield maintenance or step down. Depending on which you choose, could have an impact on your rate. Typically, a step down loan prepayment has a higher basis points hit to the rate. So, for example, if you get a 5.5 year loan, a 5.5% loan with yield maintenance, right? If you want to get a step down instead, they might bump you up to a 5.75% rate with a 55332211 or a 32100 prepayment penalty step down. So I prefer step downs just
Yeah,
because I can calculate what my exit costs are going to be. Yield maintenance is definitely a bit more confusing. Just know that they have an inverse correlation. So if the rates go up comparative to where your rate is, your prepayment goes down. If rates go down, your prepayment goes up because essentially the bank wants to lock in their profits on the
yeah,
loan. And if they can redeploy the cash and the rates are lower, then they need to lock in the profit from the previous loan. But conversely, if rates go up, they can take your loan and then redeploy it into a higher interest rate and make more money, right? So that's kind of the mindset there.
yeah, yeah. And I also, I know guys that they like that gamble. And I'm not one of them. I like the known quantity. Um, so I tend to prefer that step down as well. Because that way I know, hey, if I sell in year one, it's 3%.
Yeah,
Um,
I
you know,
like that. I prefer
yeah,
that. It's it I commonly say this. It's the devil, right?
yeah,
You don't really have to think about it too much. You just look at your prepayment penalty step down. What year am I in? And then you can time it favorably. Like, if you have a prepayment penalty that's a 32100, well, that means, months 1 through 12 is 3%, 13 to 24 would be 2%, and then 25 to 36 would be 1%. So then I can list my property for sale during year 2 and make sure that I structure it to close in the first month of my 1% penalty in order to kind of take advantage of that. I mean, because
right.
1% on the exit is really nothing. I mean, most loans have a 1 in, 1 out schedule anyways. So it can be beneficial to do a 32100. Then you have the flexibility to get out sooner if the market changes favorably.
Yeah, and you saw a lot of this guys in like 22 and 23, you saw a lot of guys that refied into this really, really low debt, and they, for whatever reason, changed their mind. And they're like, no, I think I want to sell. And then they were offering, a sell with a loan assumption, or free and clear, and you saw two different prices, right? And they were basically doing exactly what Vitali is talking about there. Is like, hey, if you want to assume the debt, this is the sales price. If you want it free and clear, I'm going to build those prepayments in, and this is the price. And then, by the way, I couldn't find any loan assumptions during that window that penciled.
No, they've definitely become, with rates when they had gone up over the last 2 years,
Yeah.
18 months. I mean, loan assumptions have made significantly more sense, but back when rates were so low, they really didn't make sense at all.
No, no. And they make a little more sense now. I think prices help with that a little bit. And then too, the buying into something now and taking over that loan, even if you have to come with a little extra leverage,
Yeah.
Makes a little more sense right now than back in the day when somebody, refied and put it on 4% debt, and then got like a 15% appreciation on top of that.
Right. Right.
Yeah, it was ridiculous.
Yeah. So what are some of the disadvantages of going with an SBL loan besides the cost?
The cost, that's one. Two, two, the time. If you're looking for a quick close or a quick
Oh,
refi, agency's not it.
I would budget a minimum of 45 to 60 days to complete a refi with an agency loan.
Yeah, minimum 45. Yeah, and you better look at 60 than
Yeah.
3. Where are we at on 3? 3, while you're in that window, you better make sure that your business plan holds during
Oh
that
yeah.
window. Yeah, because they have pretty strict, was it 90 for 90
Yep.
rules?
Yep.
And if you dip below that 90% occupancy during that 90-day window while you're going towards closing, while you're working towards that 60-day close, it could reset your clock and you're starting all over again.
Yep.
And then, where are we at? 4, sponsor track record. And I don't mean from being a good sponsor or a bad sponsor. I mean, have you taken agency debt before?
Mm-hmm.
Because if you have not, instead of 60 days, you might be looking closer to 70, 75 days.
Mm-hmm.
It's going to be a harder, more thorough underwriting process. And then I don't know if we're at 5 or 6. The next one is just the ongoing relationship, because just be honest with yourself and understand that if you take agency debt, there's an annual review process that comes along with that. They are going to review your property. They are going to be very, very strict as to what you can do with your property once you take a loan from them. For instance, Tim and I have a property where, speaking of loan assumptions, we were actually thinking about taking a loan assumption on a property. It made sense at that time. We ended up taking on the prepay for the seller because the agency would not let us add units to the property. They
I
were
forgot
like,
about that.
yeah, they were like, nope, it's this many units. This is how many we lended on. We're not
Yeah.
allowing you to add units, which kind of didn't make any sense to me, because I was sitting there going, but wait a minute, we're adding units. We're not repurposing units. We're not taking units away. We're not changing use. None of that stuff. We're literally adding units, in theory, making the property more valuable. And, quite frankly, you lent X amount of dollars on a certain amount of units, and now those same dollars are going to be lent on more units. You, Mr. Lender, have reduced your cost basis.
Yep.
So it made no sense to me at all, but is what it is.
Yep.
And so agencies come with a greater level of scrutiny and restrictions.
Yeah. But they're the cheapest. You typically, when we're looking at refinance options, they're typically the best bang for the buck because you get the longest amortization schedule and the lowest rates. So that's why, and they're, it's like a single family buyer. They go out and they buy a house for a primary residence. You're typically getting a Fannie Freddie loan. Those are the most favorable debt terms. So it's the same thing in the commercial space. All right, the next loan option, CMBS, commercial mortgage-backed security loans. Those are typically for loans that are a minimum of 5 million and up to 100. Also, the same general time frame of 5 to 10 years, though I have seen some 3-year loan refi options, amortization schedules up to 30 years, fixed or floating rate debt. They also typically give you a bit more higher leverage and competitive rates, and they're flexible with borrower profiles and property types. Where agency loans, they have kind of a box and they don't go out of that box. CMBS will look at that and say, does this actually make sense? Despite, these couple of things that go against it, does it actually work for us? Is there, a loan to be placed that's going to be secure loan in order to make us money? The disadvantage of going with a CMBS loan is the prepayment penalties can be rather high, and the underwriting process can be rigorous and it can be difficult like an agency loan. I mean, Tim and I have gone through, we have refinanced out of our bridge loan into a CMBS loan. They were more flexible with us because they were the bridge lender to go on the going in, and they refinanced out into a 5-year CMBS loan. But they were willing to work with us, and because they didn't have the rigidity of the agency loans, we didn't have to have a 90 for 90 period. We basically got it to 90. We got the income to the level that they wanted to see in order to get our refinance loan terms. And basically, the day that we could post that income, they turned around and funded the loan. So there was an advantage there because we were in a variable rate loan that was during the period when the rates were going up significantly. So it worked in our favor there. So pros and cons, right? You got a little bit higher of a rate. The buy down was a little bit more expensive, but we didn't have to have a stabilized property for 90 days. They were able to refinance this really quickly, which took out a level of risk as for the sponsors. So pros and cons, right? Really, at the end of the day. Have you ever done any other CMBS loans except for that one that I'm talking about?
No,
Me neither.
no, specifically because of what we talked about before. Like
Mhm.
Tim and I are in a group. I won't mention the group because I don't want to cause any issues for everybody that's in there. But most of the guys in there that have had CMBS loans, they have not had good experiences with them. So in fact, I know of somebody in that group that's going through an issue with CMBS right now, and they're very, very inflexible. So I just, I look for other options if I can. Now, on the one that Tim's talking about, I think they were by far and away the best option for that
For that
moment.
situation, for sure.
Yeah. So, that one worked out fine, and it'll probably be fine going forward. But yeah, as a whole, I'll explore a lot of other opportunities and options before I'll go down that rabbit hole.
Yeah. All right. The next option would be your conventional bank loans. Sometimes people refer these to as local or regional banks. I mean, kind of the sky's the limit here. It really kind of depends on your relationship with the bank. The number one thing people talk about all the time is deposits. They want deposits. They want, your monthly revenues that you're collecting the rents. They want it to go to their bank. They want, the fees to come to their bank. The more you do with that bank, the more flexible they're going to be with you. There's a couple of people in our coaching group that they have really great relationships with lenders. And like even during the peak of these rate periods, they were still getting lower subprime loans, right? Lower than the prime rate and like 75, 80% leverage. And it was strictly because of their relationship with the bank. Those relationships are very hard to form, but they're invaluable over the long run. Especially, I think the best use case for conventional banks is when you buy in a certain area and that's it. Like, for example, we're more or less based out of the Charlotte area. If we only bought properties in Charlotte, going with a conventional regional local bank would absolutely by far be the best thing that we could do, because we would find a bank that's headquartered in Charlotte, which is a lot of them, and then we'll bring all our deposits there, and then we'll just keep applying for loans directly with them. There's a couple benefits there as we cut out the broker fee, right? Typically a lending broker will charge you 1% of the loan amount. If you go direct to the bank, they don't charge you that fee. They just charge you their origination fee. So they're boom, right? You just made some money because you're not going through a broker anymore. I do see that Regional banks or local or conventional banks, they typically do have a 3 to 10 year window. I haven't seen any loans longer than 10 years. Uh, However, one of their downfalls is that they typically want to have an amortization schedule over 20 or 25 years instead of 30. What's the negative impact of that is your debt service on a monthly basis goes up because you're spreading out the principal pay down over a shorter period of time. That also constrains your debt coverage ratio, constrains your leverage. So typically, it can be hard to refinance into a conventional loan, depending on the situation. But again, if you have a good relationship with them,
Yeah.
sometimes they'll just be like, "Yeah, you know what, Tim, we like working with you guys. We'll give you 30-year loans." But if you're a new guy and you have no relationship with them and you have no deposits with them, they might hit you hard and say 20-year AM right out of the gate.
Yeah. 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 We know a couple guys that have really good relationships, really, really strong relationships with local lenders in their markets where they buy, and they can pretty much walk in the bank and just hand them their pro forma, and the bank just goes, "Cool,
Done.
um, looks good, let's do it." But man, they've got millions in the bank with that bank, and that comes after a long track record of performance, right?
Yeah,
Um,
years and years, like more than 5 years of experience with
yeah,
that bank.
yeah. So, um, it's there, it's right for the taking. It's one of those things where it's like that's why you go ahead, and sometimes it pays to develop a relationship with a bank early on and then just stick with it. Tim and I have a relationship with a really good bank in the area, a good regional. When it comes to lending, not the easiest to deal with in that regard. Their
Mhm.
proceeds at this time, their proceeds aren't the best. Their process is a little slow, but over time, as we develop a better and better relationship with them, things should likely loosen up. Um, but that takes time. That takes a lot of time. Um,
Does, but
you
it's
know,
worth
and
it.
yeah, in fact, on the deposits and the accounts side of it, guys, like over the last year and a half, our deposits, our accounts, the flexibility with the bank has gotten better and better, as we've shown that we continue to grow our relationship with them. So, I expect that to continue. But like one of the things about a local bank or a regional bank, they're great to work with. The relationships are there. They tend to be a little more restrictive, at least out of the gate. They're not out of the gate. They're not going to be quick. Um, and then, my personal experience with them, Tim and I have done a few now with kind of local credit unions, banks, and I think our experience has been pretty similar, Tim, where it's hey, we think we can get this done in 30 days, and it's usually closer to like 50, 60, something like
45
that.
to 60, yeah.
Yeah. That first one out of the gate's always going to be slow.
Yeah,
Um,
I'm glad you said that because I forgot. Conventional banks also include credit unions. I know we always say local and regional
yeah.
banks, but credit unions they also fall in this bucket. We've got a couple loans with credit unions, but they've been a little tough to work with out of the gate. But then you go back the second time, and they're like, "Oh, actually, you guys have been servicing this debt on time. You have been meeting your year-end requirements. You have been doing the reporting and everything that we've asked you to do. We're going to loosen the purse strings a little bit for you because we like your your track record in performance."
Yeah. Yeah. So those are great relationships. And guys, here's one of the things I would say is this isn't an either or thing. This is a go establish all these relationships. You need to have all of these options available to you.
Yes.
Especially, just think about the last 12 months that we just came out of. If you only had one option available, there's a very good chance that one option kind of put the brakes on things in the last year.
Dried up.
And if that's all you had, you didn't have lending at your fingertips.
Yep.
So you really need to have multiple relationships. And I think I'm not sure where you were going next, but since we're coming up on time here, I think I would say one of my favorite types of lending is either personal or a good balance sheet lender.
Oh,
Um,
totally. Yeah.
yeah. So like a private lender, like a person, or a balance sheet, a company that they don't sell their loans. The money they lend is their own. And I really like those relationships.
Yeah, the only other ones I got on my list here are the life insurance companies and HUD
Oh yeah,
FHA loans.
yeah,
We've never done a life insurance company loan. We've seen some terms from them, but they've never come in favorable enough. And like
yeah,
what we said earlier, like the agency loans are typically best bang for your buck. So it's kind of hard to place a life insurance company loan. They're pretty strict, pretty stringent, but they're safe,
yeah,
right? And then the other one would be HUD FHA loans. We've never bought a property with a HUD FHA loan, but we have assumed them before.
yeah, yeah,
We do like, the HUD loans, 35 to 40-year amortizations and terms. Um, they're designed for affordable housing, which, Tim and I specialize in LIHTC and Section 8 properties. But the disadvantage of going with a HUD loan is they can be very, very long to apply for, even longer than 45, 60 days. I mean, we've been working on some stuff. It's been taking like, what, 8 months or whatever,
yeah.
to get the loans assumed. I don't even know how to tell you how to budget to do a HUD FHA loan, except for if it is something that you are going to be doing in the affordable housing space, is you better know that going in from day one and start working on that now.
Yeah, because those are the assumptions on those are can be really, really good. For instance, not to give too much away here, guys, but um, like Tim's talking about 35, 40-year AMs and 0, 1, 2% rate during that whole period, right? I mean, we have one I do tell folks is like we got like a $560,000 loan, and our monthly payments like 1,800 a month. It's like
Yeah.
1860 or something like that.
Yeah.
Um, and that's great, right? It's awesome. It took us a long time to assume that.
Hmm.
When you go through that assumption process, you typically got to go through approval with the housing authority, approval with local whoever, the lender, you name it. And, depending on the state you operate in, one state may take 4 months to go through that process. Another state may take 7. Um, Tim and I were Tim and I were on a phone call on like I think it was like July 2nd. It was right or
It
no, it was
was.
right at the
Yep.
end of June, somewhere in there. And we were 5 months into the process already, and the housing authority that we were dealing with was like, "Man, we think it's going to be another 6 months."
Yeah. Yeah. Oh, that was a hard pill to swallow.
It was like, "What?"
Yeah.
Yeah. Um,
Admittedly, to their own fault. I mean, they kind of dropped the ball. They had an employee that wasn't really doing what he was supposed to be doing, but we're whatever. We got through that. But just don't be shocked when you go with the HUD FHA loan. Pro, ridiculously low rates, great amortization periods. Cons, it's kind of a Pandora's box and how long it could take to assume a loan. I think that most people that would buy a property with a HUD FHA loan is typically a developer that's going to refinance into a HUD
yeah,
loan after they developed a property, put it on like a 40-year loan and just kind of let it rip.
yeah, and they're great, right? I mean, now that we're through the process, we've acquired them. They're awesome.
Yeah,
And then
wonderful.
by the way, like the next guy that buys it from us, 5 years from now, can assume it too. It'll still it'll still
Yep.
have 15 years left on it or whatever it is.
Right, right.
Um, so, that's a really good piece. But hey, as we're coming up on time, like one last thing to this like buyer, this balance sheet lender and this personal lender. The one thing that you got to remember with those, a lot of times they come with higher interest rates, right? They'll come 8.5, 9, 10%. But again, you know exactly what you're getting into. But one of the things they don't come with is a lot of points typically.
Oh,
Um,
yeah.
yeah, like you may get a 9% loan with 1 point in, nothing out, right? Which think about that, your effective rate is 10% for the first year, right? And it's like, hey, if I'm in and out of that in the first year, I know I just paid 10. Whereas think about that for a second. Let's go say you put this on, a bridge loan or something else, and maybe you got 7.5%, but it was probably 1.5 or 2 points in, 1.5 or 2 points out, right? So now you're looking at what, 7 plus 3 at best. So now you're at 10. You're at 10. You're at 10 again. So,
Hmm.
be looking at those things and then look at the cost to close. Tim and I did a loan with a popular bridge lender, and we showed up, and our lender legal fees were like 35 grand, right?
Oh, mm.
Yeah. And a similar deal. that we did with a balance sheet lender, our legal fees were like 10 grand.
Yep.
So, take all of that into account. Um,
Yeah. All
don't
great.
just look at
I
the
do
rate.
love, and then you build, much like the conventional banks, credit unions, local, regional. You build a relationship with those balance
Yeah.
sheet lenders, and they really want to build a relationship with you because they want to do long term. They want to do a lot of deals. They want to know you. They want to make it a safe, secure, very easy transaction. Building relationships with those types of people are great, and it definitely like ask the question if you're talking with a lender directly. Ask the question, hey, are you guys going to package these up and sell them, or is this a balance sheet loan for you guys? And
Yeah.
not only does that spark a different type of conversation, it also lets them know what you're talking about. So definitely kind of throw one of those in there if you can.
Yeah.
And then real quick, Dennis Russell says, have you ever looked at a USDA loan? I have not. I feel like USDA loans are typically for like Midwest, like farming, agricultural stuff. I really don't have any experience with it, but I've never looked at it at the end of the day. Maybe you could educate us. Have you looked at it, Tim? I don't think
Mm,
so. I doubt it.
no, briefly, Dennis, I may be getting my hairs mixed up here. I think I briefly looked at them when I was doing some single family stuff. But I've never done one.
Yeah.
Um,
No, me neither. Yeah. So, all right, guys. Well, hopefully you guys learned something from this and found it useful. Appreciate you guys joining, and we will talk to you next Tuesday. Peace.